So in the first 2 years, you're putting in 48,000 and they're earning probably about 45 to $50,000 of commission on this policy, right? So you're looking at a horribly designed policy, but the agent is making out extremely well. Hey guys, welcome back to the channel. Michael Garcia, I See Life. And what I want to talk about today is really how to identify if your life insurance agent selling you cash value life insurance is kind of ripping you off or they're setting you up right. And so with these cash value life insurance policies, whether it's a whole life or an IUL, you can set them up different ways where you can really maximize the cash value, especially in the early years, or in some cases, you're not going to fund these policies properly. And so they're not going to grow the way you might expect, right? And in some cases, they can get you in trouble because you end up overcommitting financially, depending on how they set you up. And unfortunately, one of the reasons I'm making this video is because I came across a client that was definitely well overcommitted as far as their monthly premium, and there was no real flexibility to come down. And so we had to really restructure. And unfortunately, it's going to cost this client over $50,000 because of a large surrender charge. And so it's really important to know what you're getting yourself into, right? And so I'm also gonna break down why agents might do this. A lot of times, unfortunately, it is for the commission, right? Because insurance agents don't get paid a lot of money for you to overfund a policy. They get paid to sell you insurance, right? And unfortunately, what happens sometimes is greed kicks in, and I'm gonna break that down. I'm gonna show you in the illustration where you can see these things. So, what I want to do is show you four policies. One that is structured well, one that's structured not so well, a whole life, and an IUL, right? So let me go ahead and get into this here. And so let's get into the whole life first, right? Now, one thing about whole life, one good thing is the whole life policies are not going to lapse on you as long as you're making your premiums. So from that standpoint, it's actually really hard to mess up a whole life. But can you definitely optimize it for your client and put them in a much better situation? Absolutely, right? So we're going to take, in this case, we're using a 35-year-old male in each of the four policies. So they're all going to be very comparable as far as the client goes. They're all going to be a $2,000 premium, right? But in this policy, what I want you to see here is the breakdown of that premium. So in this case, it's payable to age 65. By the way, in whole life, if it's paid up at 65, it is truly paid up, meaning it's not a vanishing premium, right? The charges are it's paid up, right? And so that's important to know. You're not going to have additional cost coming out of this policy in a whole life policy after it's paid up, right? So it's guaranteed to be there. So in this case, if you look at the base premium out of this $2,000 monthly premium is only $535, right? And then there's a listener premium first year rider, and that's $14. If you add those together, that's $550. So what's important for you to guys, what's important here is when you are talking about an agent's commission, right? And unfortunately, I do feel like what happens too often is other agents, just as a way to attack other agents, will say, oh, they sold it just for the commission. And that's not always true, right? But the reality is you do get paid more commission to sell it all as a base policy, right? So the base policy, when you're talking about the big commission that they're getting paid on, in this case, it's not on $2,000. It's only on $535. So your agent in this case, they structured it for more cash value early on. They also made it more flexible for your client, for the client. So that way, let's say there's months down the road, their commitment isn't as big, right? They can actually drop this premium down by $1,000 later on, and they would be totally fine, right? And so when you look at the $2,000 monthly commitment, if this were a base policy, like the next example is, that is a commitment that you have to continue to pay month after month. Whereas in this case, what we've done is we've created some flexibility for the client, right? And so it's a good thing, right? We don't want to overcommit our clients. We want these policies to stay on the books, but also we want them to have that early cash value. So in this case, $1,450 is going to the ALER or the PUA, paid up additions rider. And that's basically an overfunding of the whole life. And that's going to buy additional whole life coverage, single premium paid up coverage, right? So when we go down to the breakdown of the numbers, what we're going to find is we're going to have a solid cash value in year one. So you can see here, year one, you have $24,000 going into this policy. Make it a little bigger for you. And out of that 24,000, you can see right away in year one, you have over $16,000 at the end of year one that you're going to have access to in cash, right? And so that's a big deal, because when you have access to cash, you can see in year two, 33,000, you already have over $50,000 accessible liquid capital that you can go and you can invest and you can take advantage of opportunities, right? Because the reality is, if you didn't have this money, which I'm going to show you in the other policy, that's an opportunity cost, right? And it's not that the other policy is going to lapse or necessarily be bad, but it's got a higher commitment and it's got a bigger opportunity cost because you don't have access to this capital. So you can't really use money. Now you're going to notice the death benefit, this policy at $671,000 is going to be significantly less than the next policy I'm about to show you, which is a big base whole life policy, right? And so a lot of times, remember, when you're maximizing the cash value, in order to do that, you're going to have a little bit less death benefit. So I do want to say, if you're buying the whole life strictly for the coverage, right? Your agent didn't rip you off by selling you a coverage policy. It's still gonna work, right? But just understand, could it have been designed a lot more advantageous to the client and also protected you in case you had rough months where you could lower, you had flexibility in your premium? You definitely could have done that, right? And you're going to see about a $500,000 difference. If we really wanted to make that difference up to 500,000, could do that very cheaply on a 10-year term, because in 10 years, you can see we're at 1.15 million, right? So that this death benefit is going to grow. So we can add a 10-year term for as little as probably $15 a month. And so it's really such a small commitment. And so if we go to here, you're going to notice in this case, we put all the coverage in the base policy. We're starting at 1.18 million of base coverage, right? Same client, 35-year-old standard client health. And we're looking at a $2,000 a month premium. The difference is, you notice all the premium is in the base premium. So what that means is you're committing to a $2,000 a month premium, and there's no flexibility with this policy. If you want to break down how the commissions are getting paid, well, the agent's going to get paid their large commission on the full $2,000, whereas in the previous policy, they're only getting paid on about 28% of the premium, right? The rest of the premium, they're going to get paid maybe like 1.5%, something very small for the overfunding. So in this case, if we go down to the numbers here, what you're going to see is when we look at the end of year one total cash value, we only have $1,842, right, in the non-guaranteed column after the dividends paid out, right? And the guarantee column, there's zero. So not that we're counting on the dividend not paying out. The dividends have paid out for 150 years with this company. This is Mass Mutual. But it's important to understand the other policy we had 16,000, right, in year one. We had 33,000 in year two. That's a sizable amount. 55,000 in year three. You can actually go invest in real estate. You can invest in the stock market when it crashes. So in this case, not only do you not have the flexibility, right, but you don't have the cash value. If an opportunity pops up, you're not going to be able to take advantage of it. And so that's really the kind of the issue I have with base policies, right? If you've ever, sat with me or learned anything from me, one of the things I say is you really want to have certain policies that are designed strictly for protection, and then you want to have other policies that are designed to accumulate for you, right? Cash value. And in this case, there's not a lot of cash value, right? Which could be a huge opportunity cost. You could miss an opportunity to buy a house, or if the stock market crashed in this time, you wouldn't be in a position to take advantage of it, right? So it's a big deal. But the good news is it's pretty hard to mess up whole life. If you scroll down 15 years down the road, you can see this thing is starting to build up some cash value. And at 65, you do have $1.3 million of cash value. So this thing does start humming. It just takes a little bit longer to get going. You don't have that early cash value. So it's not so much that your policy would be in danger of lapsing, like an IUL would have that danger if you were not funding it properly. This one does not have that danger because it is whole life, it's guaranteed. But you are locking yourself in terms of flexibility of your premium, and you are also you have an opportunity cost because you're going to miss opportunities early on. So that's what I would look at in a whole life policy. I would definitely look for that structure, look for that cash value early on. Like in this other policy here, we had the 16,000. That's going to be more ideal, right? What's the flexibility? How low can I bring my premium down, right? And like I said, I hate to say it's because of I hate to say it's because of the commissions, but sometimes it is, right? Sometimes the agent wants the higher base policy because it's going to pay the better commission. So in this case, like I said, you're at about 27, 28% of your total premium that the agent's really making their commission on, not the full amount. Whereas in the base, they're making their money on the full amount. So the next example I want to get into is the IUL examples. So the first one is going to be a kind of a minimum funded IUL. And so what we're going to do is we're going to break this down. You can see we have the same $22,000 a month or $24,000 annually. And so when we look over here, out of that $24,000 that's put in year one, you can see a massive death benefit, by the way, right? $4.2 million death benefit. But if we look at the surrender value, this is what we have access to, right? I just talked about opportunity costs. Well, in this case, you have zero access to your money in year one. You have zero access to any money in year two, zero in year three, zero in year four. It's not till year five when you get $26,000 of excess, right? This surrender charge, remember, this has a surrender charge. The whole life does not, right? So you have to go above the surrender charge before you get access to that money. So in this case, you can do the simple math. The surrender charge is the difference between the accumulated value and the cash and the surrender value, right? So in this case, this surrender charge is about $58,000 in year five, which means it probably started closer to $65,000, $70,000, right? If we scroll down, remember, this is minimally funded. So if we scroll down, you can see it is due to lapse on the midpoint. So you're going to have your midpoint is if the policy performs at 4% interest, right? And then the assumed is if the policy performs at 6.42%. So that's this column over here. So this policy performs at 4%. At 86, you're going to have no policy, right? It's going to lapse, meaning you poured all this money into this policy, total of $744,000, and you have zero to show for it, right? By the way, if you were to pull income out of this, you would just run out that much faster, right? And if you look at um, the current assumed rates, I can tell you, it's most of these policies not going to perform at the current assumption. Main thing is there's variable parts to these policies. These companies typically reduce the cap rates and the par rates for the older books of business, right? They show you this up front and then they change the terms. So um, if this were to earn 6.42%, you can see it starts to go backwards, even though we're not pulling income out of the policy. And so this policy is going to last longer if it's performing at that rate, but it still laps at age 94. So if the client were to live to 95, they would still have nothing to show for this policy, right? So you ask yourself, like, why would an agent set up a policy in this way? And so the answer is right here, right? If you look at this target premium, that's what TP stands for, target premium. This is the premium amount that the agent gets paid, that large year one commission. And a lot of times those commissions are going to be 100%, 110%, could be even higher. But basically, they're getting paid on $45,000 of commission, right? And so you're saying, Michael, well, I'm only putting in $24,000 a year. But the interesting thing is with companies like Nationwide, you actually have 2 years to meet the target. So in the first 2 years, you're putting in 48,000 and they're earning probably about $45,000 to $50,000 of commission on this policy, right? So you're looking at a horribly designed policy, but the agent is making out extremely well, right? And so what I want to compare it to is another IUL where we optimized the policy, right? So in this IUL, again, 35-year-old male, we're looking at, in this case, preferred non-tobacco. The other one was also preferred non-tobacco. Same premium, 24,000 annually. And so what I did for this policy, by the way, I removed the surrender charge. So if you look at the total surrender value, it's 24,000, right? So you actually have access to this money early on. And so out of the 24,000, instead of having zero access, you have $21,800 in your account, that accumulated value that you can borrow against, right? You're not going to typically borrow against the full amount, but let's say you could borrow 20 grand out of this policy right out the gate. And so it's optimized to give you the most cash value, right? You notice the death benefit, it's a far cry at about $500,000 from the 4.2 million, right? So when you're trying to optimize a policy, especially in any kind of universal life policy, for cash value, right? You are going to want to make sure that you're stripping away the cost in the policy. So in order to do that, we want to keep that death benefit low. We want to keep the net amount at risk lower. And so you can see a big difference here, right? So even in year 5 here, you have $126,000 that you have in your surrender value that you have access to, right? So that's a big deal. And so if we go to look at the commission, what I want you to see is this will be an agent kind of doing things the right way, right? I'm still not a huge fan of IUL. I definitely see how they work in certain situations. So I'm not against IUL either. But if you're going to do IUL, you want to do it right. And so if you notice that same target premium in the first example, that agent made 45,000, maybe even $50,000. In this case, out of that $24,000 premium that you're making, he's getting paid on 6,700. So now you're back into that 27, 28% range again, just like in the whole life that was optimized for cash value. This agent's only getting paid the full commission amount on about 27, 28% of your premium, right? So they're not making nearly as much as the guy making 45,000, right? But they did the right thing for you. They optimized your policy. Even though they're only making a seventh of what the other guy's making, they set you up in a much better situation with much more flexibility. And this policy is going to perform a lot better, right? So one of the other numbers you want to look for if you're wondering, hey, is my agent kind of screwing me? If you look here at the guideline annual premium, that's what GAAP stands for here, GAAP. Uh, in this case, this policy at 4.2 million is set up for you to fund $194,000 a year to maximize this policy, but you're only doing like a minimum of $24,000, right? So uh, it's really not in your best interest, right? It's set up at a more minimum, which also gives you less flexibility because you can't go if you had issues, if maybe your income changed or you had things that you had to take care of and you just sure you want to make a smaller payment. You couldn't go down nearly as much in this policy as you could this policy, where the guideline premium is that 24,000, right? You're max funding the policy already, and so you have room to come down. So if you want to take a deeper dive into maybe you're looking at an IUL or even a whole life, right? You want to check, hey, is my agent optimizing my policy for my best benefit, or are they setting me up at a minimum funding? Are they setting me up to miss opportunity? Are they setting me up to fail? Feel free to reach out, schedule a discovery call with us, and I would be glad to go ahead and dive deep into what's going on in your policy, what are the things to look out for, right? And then can we optimize that policy even better? Can we get you more cash value early on? Can we maximize your opportunities, especially early on? That way you can start to utilize your policies. Uh, that way you can start to utilize your policies to grow wealth, right? Because one of the big benefits of cash value life insurance is obviously the opportunity to leverage it, right? To optimize it, to have access to that capital. So when those opportunities come up, you're in position to take advantage, right? So yeah, if you want to make sure that your agent is setting you up right, you just want a second opinion. Like I said, click on the link in the description, book a discovery call with us, and make sure to like and subscribe to the channel. And I'll see you next time.